there are risks remaining, right? And they're escalating right across the whole global financial system.
I'm sure there will be more financial aftershocks. It would be a serious mistake for the Federal Reserve not to remain focused on its objective of containing inflation.
We have inflation still above trend here, and that has to come down. And that means more hikes, not less hikes.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The hits just keep on coming for Credit Suisse. The bank says it found material weaknesses in its financial reporting since 2021, and client outflows continue. Critics sound off. Ken Griffin joins a small but vocal group of market participants warning the U.S. actions on SvB could lead to moral hazard. And US CPI data later today may add a twist to the drama. Investors brace for another bumpy ride as we get the readout on inflation for the month of February. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, the focus will switch to consumer price index, the CPI inflation data out of the US. Will it be ignored by markets, or will it be a timely reminder of the inflation fight that still needs to be underway?
Yeah, I suppose a lot of it depends on what numbers we see at the release, right? If it's a big miss or a big beat, maybe that's more meaningful than just coming in line. We're expecting 6% year over year for the headline number. I think 5.5% for the core number. In any case, in terms of what we're looking at on futures today, up about 0.5%. But there has been so much volatility in this market that these numbers are all very much subject to change in the next 4.5 hours before the market opens. You can see the U.S. two-year yield right now adding 19 basis points to 416. And in a moment, I'll show you, we've just been up and down all around the shop, as you might say, in England, in jolly old England there. The U.S. 10-year yield at 357 right now, barely changed. So the front end of the curve moving a lot. And indeed, the long end is moving a lot as well. But the 10-year yield just absolutely unchanged right now. Bitcoin, very interesting, up about 0.4%, but getting back towards $25,000 right now at $24,340. What I think is really fascinating is what's driving the price moves. Of course, we have a show focused on crypto. That airs at 1 p.m. New York time today. To me, it seems like when a lot of people are withdrawing Bitcoin from centralized exchanges, those exchanges have to transfer out of treasuries into the cryptocurrency, and that's part of the upward pressure on the price. Let's take a look at the two-year yield right now, because that is where you see massive volatility. So at one point, we were up above 420 on the two-year yield. At another point, we were down at 382. So it's been huge in terms of the swings that we're seeing. And right now, we're bouncing back again. But you see this volatility in bank stocks. You see this volatility in massive indexes as well. So big swings are what we're prepared for here in the U.S. today. What do you see, Anna, in Europe?
Yes, all over the shop is the phrase we use here in little old England, Matt. But it is entirely appropriate today because we are all over the shop when it comes to what stocks are doing here in Europe with the two-year yield, as Matt, you just highlighted. Certainly a lot of volatility there. So this is the picture across European equity markets, some weakness in London, some strength elsewhere. But the gains we are seeing, not entirely secure, it feels. We're kind of half and half divided between the sectors as to those going higher, those going lower. Not a great deal of conviction, it would seem, in it right now. Let's have a look at the European expression of some of that bond market story that Matt was just talking about. This is the German two-year yield. I picked out the German two-year, and we're seeing the yields dropping here at this particular time horizon. Further out the curve in Germany, we're seeing yields going higher. In the UK, we're seeing yields going higher across the curve. So things looking a lot less uniform when it comes to the bond market story right now, and things, as Matt was saying, looking volatile. This is the property sector, one sector that's doing really well here in Europe, up by 1.6% today, as we've seen the direction of travel for lower yields over the last couple of sessions, and those expectations coming in as to just how much hiking we are not going to see from global central banks. That, it seems, is being considered well by those companies that are exposed to that interest rate in the property sector. Volkswagen is down by 0.6%. The company saying it's going to spend more than we previously thought when it comes to its capex around EVs. So that's something for the market to consider. And Credit Suisse down by 4%. So many news lines here. They're talking about material weakness in their reporting from 2001. They're also talking about outflows at the business and more broadly this news falling into a sector, Matt, a banking sector that is extremely nervous around SVB. We've seen CDS widening, a sign of nervousness around the banking sector here in Europe.
Yes, the SvB story continues to rattle around markets. A huge surprise. One bank that we're never surprised to hear bad news about is Credit Suisse. Bloomberg's finance reporter Tom Metcalf joins us with even more of that. What can you tell us, Tom, about what's going on now at Credit Suisse?
Well, yeah, a big surprise announcement today. Basically, their annual report came out, and one line in there, or some elements in there, about there's material reporting weaknesses for its 2022 and 2020-21 results. So, look, that is a process thing. They're not saying, you know, the sort of fundamentals of those reporting is, or the results are wrong. But what they're saying is, you know, we haven't quite got our financial reporting right, which, as you can imagine, is pretty bad news if you're a bank.
And you can, yeah, I mean, I guess we had some sense that this might come, given the SEC's concerns around it, didn't we, Tom? But one thing we're also watching, of course, is IPO plans at CS First Boston. What can you tell us about how far advanced those plans are?
Yeah, a few more details coming out. So now it seems that about 20% of the equity is going to go to sort of senior leaders. Employees will get restricted stock units. And, you know, it's just it's taken shape, that unit. And obviously, you know, big challenge they have to sort of establish themselves as this, as they call it, a super boutique, a super advisory boutique. But yeah, starting to look like, you know, there'll be a lot of skin in the game for its top bankers at least.
All right, very interesting to hear more details about CS First Boston. Tom, thanks so much for joining us. Tom Metcalf there. Now, let's get back to really the shocker that has run around markets the last couple of trading sessions. A small but vocal group is emerging as critics of the U.S. government's emergency backstop of the financial system after SVB's collapse. Billionaire Ken Griffin told the Financial Times the U.S. government shouldn't have intervened to protect all depositors at the bank. Meanwhile, former Treasury Secretary Larry Summers praised the actions taken.
The authorities over the weekend did what they needed to do. It was clear that if there wasn't assurance put behind deposits, both deposits in the failed institutions like SVB and deposits in other institutions, that you were going to have enormous chaos this week.
Sonali Basak, our global finance correspondent, has the latest Wall Street response to the collapse of SVB, and there's a little bit, I guess, of a debate brewing here.
A huge debate brewing. You have the likes of Bill Ackman agreeing with Larry Summers, saying the government made the right actions. But then there's this large chorus also warning of moral hazard. That crew, as you said, includes Ken Griffin, who also believes that capitalism is at risk also. Capitalism is breaking down before our eyes, he told the Financial Times.
Dramatic.
Well, there's a lot of drama behind the story, Matt. And so you have the others, like the likes of Cliff Asness here, saying this creates moral hazard for depositors who no longer think about where they need to put their money. Carson Block of Muddy Waters says the same thing. This is particularly for corporate clients that are more required here to manage their risks. Jason Furman of Harvard Kennedy School, of course, prominent economist, also says that he's less worried about moral hazard, but more worried here about the idea that the system failed. There's this other dynamic also going on, this view, guys, that there is this kind of backdoor QE being created behind that Fed facility created because of holding the bonds at par. This idea that you're still holding 30 to 40 billion or more worth of kind of write-downs here that exist under the system. So are they pumping the system with more liquidity? Is this an inflationary impact just at the time you don't want to see it? So a lot of concerns about the distortions to the market that are created by what we've seen done over the weekend.
Okay. A lot of big voices then raising questions about what this means for markets, what it means for global capitalism. What about whether we are heading for a major financial crisis? I know that Michael Burry of Big Short fame doesn't think so.
Yeah, he doesn't, and there's other people who have different views. You know, on one hand, you have Bill Ackman thinking more banks will fail. That's a pretty popular view out there, thinking that more banks will feel stress under these kind of tighter liquidity conditions. But like I said, was that liquidity just eased in a major enough way. On the other hand, you have Guggenheim's Ann Walsh, the CIO there, who believes that this was a bear moment, that this could have been a bear moment, that this was kind of early 2008 where there's a harbinger of more things to come. Remember, a lot of people are pointing to the fact that this is not the the first liquidity-induced kind of crisis here. You think back to what happened in the pension funds in the UK just months ago, and you're seeing drips and drabs of unintended consequences. Most people would have told you that they didn't think that this was the canary in the coal mine, but there are concerns still under the market about what comes next.
And both people on both sides of the argument, I should say, are pointing out that, money printer go burr again, right? Yeah. It's no longer clunk. It's back on. Sonali, thanks very much for that. We should mention that we're seeing a rebound in regional bank stocks in pre-market trading. So any of those that have taken huge hits like First Republic or Western Alliance are now seeing a bit of a bounce this morning. Let's get to the Fed response, or what we expect, especially after the big data that we're going to get. Fed Chair Powell's strategy to speed up the central bank's inflation-fighting efforts unraveled in the wake of SVB's collapse, with fears about financial stability or instability overshadowing today's CPI print. Kriti Gupta, our markets correspondent, joins us now for a preview of that data, and it could be a really big number.
It could be a really big number. And look, you're already seeing some of Wall Street kind of differ on what that number will be. Now, the economist estimates surveyed by Bloomberg are about 0.4% rise on a monthly basis, a yearly increase of 6%. Bloomberg Economics, on the other hand, our research arm, coming out saying, look, it could be even higher. And it really comes down to the components, because a lot of the kind of sticky parts of inflation have been that housing piece, where you've started to see a deceleration in commodity prices. I believe we had a bet on this that you beat me on, but essentially
so far
true, it could double peak. Anyways, oil prices coming down, food prices coming down, not really helping the end consumer, but housing and wages staying a little bit sticky. This time around, you're seeing calls that, look, in the last couple of months, utility prices, specifically in California, have gone up quite a bit. You've seen a lot of the kind of gas prices come up as well from that trough that we had seen in commodity prices. But you might be seeing a deceleration in housing finally. So there's a lot of moving parts here. And when it comes down to what the Federal Reserve is going to do, it's all about breadth. How broad is the inflation when you look at the basket?
So we'll focus in on the inflation picture, and usually we'd say this is going to be front and center for what the Fed does next, but we know that there's the SvB fallout that in some people's view needs to be factored in. Others say, actually, that's a different part of the Fed, and it shouldn't let that get in the way of monetary policy. What does all of this mean then for Fed pricing?
Well, you're looking at a terminal rate now priced in the market of about 5.1%, and that is very significant. That's why you're seeing such a dramatic move in yields as well. But Anna, I think the best way to describe it is to just look at the divergence you're seeing on Wall Street. If I can throw some numbers out at you, Morgan Stanley, for example, Citi, still saying 50 basis points is in the cards. And you have the folks over at Evercore, JP Morgan, saying, well, actually, we're going to go back to 25. Goldman, Barclays, saying there's going to be no hike at all. It's going to be a pause altogether. For me, I think the highlight of all of this, all the Wall Street calls that kind of came in yesterday, pre-CPI, I might add, give it a couple hours, I'm sure some of the calls will change. Nomura saying a 25 basis point cut and an end to QT. To Sonali's point earlier, the idea that QE is kind of built into the system that the Fed and the FDIC have now created, there's an interesting talk about whether QT is really necessary at a time when you're trying to establish that financial stability, or at least reinstill confidence in the market. So I think that is going to start to become more and more part of the conversation going into the meeting next week.
Yeah, QT seems a long way off when they're just pumping out money to bail out depositors in big institutions like SVB. Kriti, thanks very much for that. Bloomberg's Kriti Gupta talking to us about what to expect from CPI and the Fed. Let's take a look at some of the stocks we're watching in the pre-market this morning. GitLab, which is, I don't even know if I can say that in the UK. Apparently Git is a very bad word there. Shares dropped 30% in post-market trading after forecasting revenue for the first quarter and full year that trailed analysts' estimates. So huge drop for GitLab. United Airlines warned it will post a surprise loss this quarter as it grapples with high labor costs. So you can see United down almost 6% in the pre-market. And then Standard & Poor's says Bungie will replace Signature Bank. This is not the video game maker connected to Halo or Call of Duty, but an agriculture company is going to replace Signature Bank in the S&P 500, and that gives it the requisite pop. Right now, 7% in the pre-market. And then finally, a court ruled that Uber, as well as DoorDash and Lyft and other such companies, can treat workers as independent contractors rather than employees under the California voter-backed initiative known as Prop 22. Anna?
Okay, lots to watch then when it comes to pre-market. Coming up on this program, we'll talk to Mathieu Savary, BCA Research Chief Strategist. How much is he having to rethink his Fed expectations, or maybe not at all, based on the SvB fallout? We'll get his take. We'll also discuss the impact of SvB on crypto and on regulation. We will be joined by Liz Boison, who is a partner at Hogan Lovells. That regulation conversation coming up shortly. This is Bloomberg.
Well, the volatility has been nuts. This is Surveillance Early Edition. I'm Matt Miller here in New York with Anna Edwards out in London. We're looking at such a volatile market that things move along more quickly than we can update headlines. This is the 2-year yield, and what we had seen for a moment was the biggest 4-day drop since Black Monday in 1987. But now the 2-year yield is climbing again. So it was only actually down for 3 out of the last 4 sessions. Still, that 3-day drop is the biggest that we've seen since Black Monday as well. So it goes back a long way, as you can see by this chart, fantastically put together by Daniel Curtis for us in London. Just incredible volatility and unbelievable to watch a 2-year yield go from, I think, more than 5% on Wednesday to 382 for a moment early this morning. Justina Lee joins us, Bloomberg markets reporter, to talk about what's driving this roller coaster ride. Justina, it's understandable if it goes in one direction, but why up and down and up again?
Yeah, I think that just really points to the whipsaw in sentiment. I mean, I remember last week before SvB, we were still talking about whether it's going to be a 25 or 50 basis point hike from the Fed this month. And now we're talking about 25 or even 0 or even a cut. And I think it's a sign that, markets kind of see that the Fed doesn't really have a great risk appetite right now for more instability in the banking sector. And maybe they're more worried about that. But it's easy to kind of forget that. I mean, before all of this, we were all thinking about how the data has simply been too hot for comfort for the Federal Reserve. And that's why today's CPI is really important. And I think that's why you're kind of seeing yields bouncing back up again.
Okay, so it's a complex picture on bond markets. It looks less uniform than it did over the last couple of days, Justina, as if there's more nuance or people just more confused, maybe, as to where we go next. Justina, what messages are you taking from stocks? US futures look slightly more positive. European stocks, fairly flat, despite heavy selling yesterday. The DAX down by more than 3% in session yesterday.
Yeah, I think yesterday's moves were quite bond-driven. I mean, we saw, tech stocks coming back up, and that's usually because they're very sensitive to what happens in the bond market. And, at the same time, we saw widespread risk aversion. Value stocks got slammed, small cap stocks got slammed. And I think today you're kind of seeing a lot less of that divergence. And that's another sign that markets are kind of calming down today and kind of shifting the narrative back to what happens with monetary policy.
Okay, Justina, thanks very much. Bloomberg's Justina Lee with the latest on markets. And for more market analysis, check out MLIV Go on your Bloomberg terminal. That's where you'll find the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Let's keep you up to date now with news from around the world. Here's the first word. Chinese President Xi Jinping and Ukraine's Volodymyr Zelensky are said to be planning a video call in what would be their first conversation since Russia's invasion. The Wall Street Journal reported it could come after Xi visits Moscow, a trip which could come next week. President Biden, meanwhile, says he expects to speak with China's leader soon himself once the government in Beijing returns to work following the National People's Congress. So a lot of meetings ahead. The U.S. system of federal home loan banks is ramping up the amount of cash it has available to deploy as the failure of several U.S. lenders stokes expectations that more regional lenders will need to tap it for funds. The FHLB system, a key source of cash for regional lenders, raised $88.7 billion through the sale of short-term notes, exceeding the $64 billion initially planned. Fannie Mae has postponed the sale of more than $500 million of mortgage-linked bonds sold by Nomura and Morgan Stanley. Bloomberg has learned Fannie Mae alerted investors that the deal, which is a $542 million credit risk transfer security, would be delayed, citing market conditions. The securities are riskier than regular Fannie Mae mortgage bonds because they are among the first to take losses when homeowners fail to make payments. U.S. prosecutors are looking into chat group conversations among prominent trading firms about a potential bailout of the Terra USD stablecoin project. Manhattan federal prosecutors are probing conversations on Telegram among employees at Jump, Jane Street, and the now bankrupt FTX affiliate Alameda Research last May, and whether possible market manipulation was involved. Anna?
Coming up on the program then, Matt, Mathieu Savary joins us, BCA Research Chief Strategist. As the fallout from the Silicon Valley Bank fiasco, is that having an impact on your Fed calls? Or do you think inflation rather than recession remains the biggest risk for 2023? We'll ask Mathieu. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. The hits just keep on coming for Credit Suisse. The bank says it found material weaknesses in its financial reporting and client outflows continue. Critics sound off. Ken Griffin joins a small but vocal group of market participants warning the U.S. actions on SvB could lead to moral hazard. And US CPI data later today may add a twist to the drama. Investors brace for another bumpy ride as we get the readout on inflation for the month of February. I'm Anna Edwards in London with Matt Miller in New York. US futures point a little bit higher, but such is the volatility in fixed income markets, Matt, that I'm not sure anyone's got a great deal of short-term conviction.
Yeah, absolutely. And we're going to get, of course, that CPI print, something that has, over the last year, very much moved markets at 8:30, so that an hour before the market open, we could see these numbers change drastically. S&P futures right now about 1/3%. In the cash trade, we closed down just a bit yesterday, about 1 or 0.2% off the levels that we saw in the close on Friday. So there hasn't really been a lot of movement on the broader index over the last couple of trading sessions, even though, of course, last week there was a lot to the downside. And, of course, bank stocks have been dragging on indexes around the world. The U.S. two-year yield currently up 22 basis points. So the price is falling and the yield is rising once again. This after we saw the yield absolutely collapse in the previous three trading sessions. We went from 5%, more than 5%, down to less than 4%, but now we're climbing up to about 420 at the front end of the curve. The 10-year yield not moving much at all. Right now down almost 2 basis points at 359, but remember the 10-year also was up over 4% last week, so it's moved pretty quickly for a fixed income instrument like this. Bitcoin also rising a bit right now, $24,277, and it rose in yesterday's session as well, possibly as more investors pull the cryptocurrency off of centralized exchanges, forcing those exchanges to then sell their treasuries or whatever they had invested in with the Bitcoin and buy crypto instead. Take a look at some of the pre-market movers. There's a lot going on under the hood this morning. First of all, in terms of the banks, a ton of the banks that got hit very hard. I mean, First Republic has lost 3/4 of its value over the past 3 trading sessions, getting a little bit of a bounce now in the pre-market. And the same is true for these PacWest, Western Alliance, Schwab even taking a big hit and now rebounding a bit. Then in terms of non-bank movers, GitLab is one of those. It dropped more than 30% in the pre-market, down after forecasting revenue for the full year that missed analyst estimates. United Airlines is another one getting hit hard in the pre-market, warning that it will post a surprise loss this quarter as it grapples with the high cost of labor. So maybe plane ticket prices won't go down. Standard & Poor's added Bungie to this S&P 500 to replace Signature Bank, which of course was seized by the FDIC and closed on Sunday. So that gives it a requisite pop in the pre-market right now, about 7%. And then watch Uber or Lyft or DoorDash or any of those companies that treat employees as contractors. They are now allowed to do that according to a California appeals court backing the California voter-backed Prop 22 initiative, and shareholders like the look of that. Uber, for example, up more than 4%. Anna, what do you see in Europe?
Yeah, well, just as I've been standing here listening to you there, Matt, we've seen the European stocks tick down into red. This was green just a few moments ago, but now down into negative territory on the Stocks Europe 600. Yesterday, we saw losses of more than 3% on the Xetra DAX. We saw other European equity markets really coming under pressure, possibly because we've seen such strength in European stocks and specifically around banking stocks since the start of this year. So some of that year-to-date enthusiasm in banks specifically, but more broadly as well for European stocks being unwound over the last couple of days or so. Credit Suisse, it's part of that narrative, but then goes beyond that, of course, because that stock getting some extra movement to the downside as a result of some news lines coming out of the company saying that they found material weaknesses in terms of their financial reporting. It's more of a process story, but adding to nervousness around the market and around the banking sector, of course. They also talk about outflows today, news lines there. Volkswagen down by 2.5% as the car maker says it's going to invest more than have been previously thought in EVs. And the German two-year yield, Matt was just talking about what's going on the US side, and we're seeing some convergence really around what's going on in bond markets. We see some selling of the 2 years, some selling across the board, actually, across European debt markets, and we see those yields then rising just a little. And that now, this morning, we seem to have coalesced around that being the direction of travel for the moment, at least, as we wait for that CPI data, Matt.
Yeah, absolutely. Looking forward to that at 8:30 Wall Street time. Joining us now is Mathieu Savary, Chief European Investment Strategist at BCA Research. Mathieu, thanks so much for joining us after the volatility of the last 3 trading sessions since really the bank run began at Silicon Valley. Has anything changed, in your opinion, in terms of the financial system? Have conditions gotten tighter? Are you less concerned about rate rises from the Fed, the BOE, the ECB?
Well, yes, things have definitely changed. It is very possible, even likely, that the SvB problem will remain contained to SvB. There are some very specific facts that suggest so. However, financial conditions have tightened significantly. We're talking about financial condition indexes that have jumped, credit spreads that have done the same thing, the volatility index for the bond market that is much higher. And what is really concerning me is the fact that cross-currency basis swap spreads are widening again, which usually is a sign that there are underlying tension in the market. So this is definitely changing the equation quite a bit at this point in time when it comes to the outlook for rates. Specifically, when it comes to the Fed, it looks like a pause now is very, very likely at the upcoming meeting. The ECB is likely to increase interest rate at its also upcoming meeting, but then become much more careful about how it's going to communicate what it will do afterward.
You know, we're going to get, obviously, CPI in just about 3 hours from now, which will show us the latest snapshot of inflation. If it's bad, the Fed is going to want to continue to tighten, I imagine, especially since financial conditions, you and I look at the Bloomberg FCON Go or Goldman Sachs or Citi or some such financial conditions index. But the Fed, as Emily Graffio from Bloomberg News recently wrote, looks at much more simplistic measures, like mortgage rates, for instance, which have come down pretty dramatically as a result of this. So even though we feel financial conditions have tightened, it may look to the Fed like they've loosened a little bit, and if inflation is high, why wouldn't they continue to raise rates at a pace of 25 or 50 basis points?
Well, the key word was pause, in the sense that here it's an opportunity to reassess the situation. You're absolutely right that if inflation remains strong, the Fed will restart hiking interest rate. At the end of the day, all the programs that have been put in place around SVP, Signature, Bank, and so on, have been put in place to give the Fed the option to keep increasing interest rate if the economy demands it. So that's why I think it is way too early to call the end of the interest rate increases in the US or even in Europe, and that instead what we're seeing is a moment for the Fed to pause, think, assess whether or not there are deeper damages to the banking system and the economy at large from the SvB crisis. But ultimately, the Fed's decision on a few months basis will be guided by inflation, by the labor market. And right now, they don't really send a signal that the Fed needs to completely halt its interest rate increases.
Okay, so Mathieu, if we do see a pause from the Fed, you think then we shouldn't interpret that as the end necessarily of the hiking cycle? I was drawn to some research, Capital Economics, saying that they draw inspiration, I suppose, from the LDI crisis in the UK, saying that, yes, the BOE used its balance sheet to ease the liquidity issues in the short term, but then subsequently went back to raising interest rates. I mean, could we see something similar then from the Fed?
Yes, absolutely. What we are seeing, this LDI crisis, the SvB crisis, the fact that we're seeing financial accidents is symptomatic of the reality that the Fed and other central banks have tightened monetary condition considerably over the course of 2022. And when financial conditions, monetary conditions are becoming tight, we tend to see financial accidents pop up around the system. And that's exactly what we're seeing right now. But those financial accidents, if they remain contained, if they remain localized, and they can be kind of ring-fenced, they will not preempt central banks from fighting inflation further, because at the end of the day, their number one concern remains right now that inflation becomes entrenched, inflation expectation gets unmoored, and that's what they really worry about.
What do you make of what we've seen in European banks, Mathieu, over recent days? Real weakness across the banking sector. Is there some profound worry there, or is this just a function of a reassessment of how high rates go, what that does to margins for the banking sector?
So I am not worried about the European banking system. I don't think there's a crisis there. When it comes to, again, the specific of SvB, there was deposit outflows taking place from a bit because all those startups were pulling on their cash right now. European deposits are still growing. Now, that doesn't mean that this correction, this pullback wasn't warranted. European banks had a very substantial run lately, and the reality is that they were already facing some headwinds. The ECB had tightened considerably. We had seen M1, so money supply growth, really slow and in fact start to contract in Europe. Credit flows for households and corporations had really collapsed. Credit standards have become much tighter, credit demand much weaker. All of that historically lead to lower credit growth and lower EPS for the banks and for the financials in general. And on top of it, the reality is that monetary policy acts with a lag. So we are seeing those signs that monetary policy is already starting to affect credit dynamics in Europe. And this is despite the fact that we haven't seen the bulk of the impact. So I think, yes, we could see some downside to European banks, but that's more related to the earnings side caused by the tightening in monetary conditions.
Mathieu, thank you very much. Mathieu Savary of BCA Research, thanks for bringing us your insights. Coming up on the programme, we'll discuss the impact of SvB on the regulatory environment and on crypto. We will be joined by Liz Boison, who is a partner at Hogan Lovells, can bring us her expertise shortly. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with the US Energy Secretary, Jennifer Granholm. That's at 5 p.m. New York time. This is Bloomberg.
We've made very clear that we would like to be chartered and supervised by prudential regulators such as the Federal Reserve, Treasury, or the OCC. We think that's critical. If you're going to build a digital dollar and you're going to build that on the internet and it's going to be accessible and usable as a financial market infrastructure, we believe we need to be kind of licensed and registered at that level. But those institutions, they need Congress to act. Congress needs to provide them with the statutes to enable an issuer such as ourselves to be regulated and supervised that way.
And that was Jeremy Allaire, the CEO of stablecoin issuer Circle, speaking earlier on Bloomberg Television. Liz Boison, partner at Hogan Lovells, joins us now from Washington. Liz advises companies and financial institutions in the payments and crypto spaces on financial regulatory compliance and enforcement matters. And Liz, I wonder how much your concerns have changed since the SvB meltdown that we saw last week. Circle, for example, had, I think, $3 billion at SvB. Now, thanks to the Fed, the FDIC, and the Treasury, they're going to be able to get all of that back. No more worry about insured levels of deposits. Everything is backed by the full faith and credit of the U.S. government. Does it matter?
Yeah, that's a great question. You know, there's a really limited opportunity here for moral hazard. No one knows how long this short-term funding would last. And so limited opportunity for gamesmanship. For crypto or other companies that did keep their funds at the banks that have been backstopped, it obviously makes a world of difference. And generally, banks where they primarily had commercial deposits in excess of FDIC insurance levels, it really made a world of difference to institutions like that.
What about regulation now? I mean, we had expected stablecoins to be some of the regulation, some of the low-hanging fruit that this Congress would be able to pick, but it doesn't seem like they're really in a hurry to do it. Are we going to get any stablecoin regulation this year?
So there's no reading the tea leaves on whether this will accelerate or in any way delay legislation that otherwise has been in progress. It may inform the contours of what that legislation looks like. For instance, stablecoins being backed by certain types of assets and where those assets are kept. We've already seen the SEC act on custody rules and designate what is and is not a qualified custodian for crypto assets. I think in the stablecoin realm, it would be reasonable to require a certain distribution of fiat assets that back a stablecoin. So there may be more of a reach into the substantive world that becomes part of any stablecoin legislation.
Liz, good morning to you. So away from the specifics around crypto regulation, more broadly on the regulatory front, do you look back to 2018 and the introduction of the Economic Growth Regulatory Relief Consumer Protection Act that came into law in the US that freed mid-sized banks such as SvB from some of the more strict post-crisis regulation? Do you look back on that and draw a link between what we're seeing at SvB and that law?
It's really early to tell if it was some change in regulation that spurred that. What is for sure is that it was near-term and specifically short-term interest rates by the Federal Reserve being hiked up that led to a really, proximate cause situation here. Whether it was a specific regulation or market intervention that caused it, I don't think that's entirely clear, but the one thing that is for sure is when interest rates go up, the business of running a bank becomes a great deal more expensive. And I think there will be some regulatory inquiries into exactly what happened at Silvergate, those directors, officers, especially around what they did on last week's capital raise, whether there were any misstatements, any potential lulling of the market. Those will be examined closely, but it will be at the institutions specifically that were put under receivership first. I don't think there'll be a more comprehensive look at the banking sector and the effect of that type of regulation just yet.
Okay, so you don't think that this will trigger some sort of review of the size of institutions that face the toughest regulation in the US?
If anything, I think this is a indication that regulation and a lot of the post-Dodd-Frank reforms worked. And thank goodness there was this kind of regulatory intervention and market intervention available. A lot of my friends who did that kind of hard work in the government, their work has paid off, that these kind of facilities became available. What may come is some sort of indication to banks that they should be diversifying among retail and commercial customers, whether the business of being a commercial or merchant bank is a thing of the past. I don't think that's the case, but it certainly will lead to a closer look at those institutions.
Liz, great to get your insight. Thank you so much for joining us this morning. Liz Boison, there, a partner at Hogan Lovells, talking to us about the potential for regulation in the crypto space and what's changed since the blow-up of Silicon Valley Bank. Be sure to catch, by the way, Bloomberg Crypto today at 1 p.m. New York time, 5 p.m. in London. It's our weekly show that covers the people, transactions, and technology shaping the world of decentralized finance, and Liz is one of those people. So great to have her voice. This is Bloomberg.